Hello, everyone. So this is a continuation of derivative markets and instruments topic, right? In the previous video, you have seen and discussed forward and futures, and today we will continue with another famous and widely used instrument that is option. Okay, so option, what is the meaning of option? Of course, option means a choice, right? So this is very different from the case of forward or futures that we talked last week or in the previous video. In the forward and forward or futures, you don't have an option. So both counterparties have to be committed to the positions that they have taken, right? So one or more of them are taking the long position and the others are taking a short position, right? So for the case of forward or futures, they don't have an option, they don't have a choice, but to be committed or to execute the positions, the respective positions that they have been taking. Okay, so that's our topic for today's discussion, which is about option, about like a choice, right? And we'll see a lot of technical things today. And as usual, if you have questions, just turn on your mic and speak. Okay, so okay, what is the option? Option is another derivatives instrument. So again, derivative instrument means you have you have the time frame, right, to execute no the contract, right? So last week we saw difference between the spot and forward position, right? So this is pretty much the same. So you have the spot position, spot transaction. Again, in the spot transaction, you make the deal right now and you execute it right now. So that the meaning of right now could be t plus 2 or t plus 3, right? But within a short band of range, right? Short range of time. So could be t plus 2 or t plus 3 at the spot transaction. On the other hand, you have the like last week we saw forward or futures, right? So we have forward, futures, and now we are seeing options, right? The pretty much the same by nature in the sense that they are derivative products, right? So in this kind of instruments, you make the deal right now, but you execute or you strike uh, the transaction in the time to come, right? It could be 5 days later, could be 1 week later, right? Could be next month, could be next year, could be the next 2 years, and so on. Okay, so again, the execution will happen sometime in the future. But what is the difference now? We saw forward and futures, forward or futures, right? So both party were committed, right? Committed. So they were committed. So they have commitment. So something that they have to execute. I think last time, in the last video, we had an example of who is that Richard and who is the other guy? Uh, is it
Marian, Sir Marian.
Farian? Yes. Now maybe today we use yeah, another person. Let's see, maybe Abian and Anissa. Okay. So now
Sige po.
yeah. So last time we saw like both commitments, right? Commitment from the long position taker and that from short position taker. I will still remember a long position. This is the like holding or buying, right? Short means no, you're selling, right? You're letting it go, right? You're shorting, you're selling something, right? So that both counterparties agreed to be committed, right, to execute their respective commitments, right? One party would take the long and the other would execute the short. But today we are seeing an option, right? Option itself means a choice. So let's imagine a situation, right? Let's say, so Abian and Anissa. Okay, so Abian and Anissa are making a contract, but this time one of whom has an option. Let's say what's the was it the underlying asset? Could be maybe fish, right? The arowana fish, right? The expensive fish. So let's say Abian is taking uh, like a buying position, right? A long position, and Nisa is taking the short position. So the contract says that within 3 months, okay, Abian will buy, I don't know how many, maybe uh, several groups or several whatever, several tanks of the beautiful fish, and the price at the contracted price of, let's say, 1 million, right? Yeah, could be more. I know the this kind of exotic fish is so expensive, right? Even one fish could cost more than 100,000 or so, right? So 1 million, a moderate price. And Anissa is taking a short position, so she will deliver the fish and is supposedly get the 1 million from Abian within 3 months, right? Okay, but this is an option, right? This is an option. So now Abian is having an option, right? So last time we saw forward and futures. So in the forward and futures contract, we know that after 3 months, Abian will get the fish, and Abian has to pay $1 million. Right? On the other hand, Anissa would deliver the fish and get $1 million from Abian. So that was forward or futures. But now Abian has an option, right? So let's say 3 months later, 3 months later, the market price of the fish, similar type and also similar amount of fish, such as this, has a market value of 1.2 million. So simple question, right? Will Abian execute this contract? So Abian has a contract, to get the fish, right? Has an option, right, to get the fish at 1 million within 3 months. So about 3 months later, the price of the fish in the market of similar type or similar amount is 1.2 million. Should Abian execute this contract?
Yes, sir. I
Yes.
think we should.
Why?
Because it gave him a revenue of 0.2 million.
That's right. Simply cheaper, right? Cheaper. So if Abian executes the contract, he can get this type and amount of fish at 1 million, right? But in the market, uh, he would have to pay 1.2 million. Okay, so Abian will execute the contract, right? And whatever amount he will get, right? Minus the contract fee and everything. So uh, now Abian has a contract, right? Has an option. So what about let's imagine the market price, right? 3 months later is about 750,000, right? So under the forward or futures contract, Abian has no choice but to execute the contract because that is a commitment, right? Forward or futures. But now he has an option. The market price of this fish, right, of this amount is 750,000. So should Abian execute the contract that he has to pay
No,
1
sir.
million? No way, right?
No.
No way. It's too expensive. So he will abandon the contract. Goodbye. He will do nothing with the contract. So the contract would expire without execution. Now, simple question, right? Simple question. Who is at a more favorable position, Abian or Anissa? Who has the choice between Abian
What
and
choice,
Anissa?
sir?
The choice to
What?
execute or not?
Abian, I think.
Abian, right? Abian is at a more favorable position. Anissa is passive, right? She's waiting because she's taking the short position. So she has to wait for the decision made by the long position taker. That's why now under forward of futures, there's no price. There's no price for the forward of futures. Right? Of course, there is value. There's the value of the forward of futures, right? In the sense that there's the contracted price, but there's no value to the contract itself, right? But here in option, Abian is again at a more favorable position because he has an option, whereas Anissa has to wait. So Abian has to pay for the price of the option, right? Price of an option, and this is called what? Option premium, of course, right? Option premium. So this is the price of the option that has to be paid by the long position taker. Why? Because the long position taker has the flexibility, right? Actually, Abian in this case, you just say, okay, forget it. So I will walk away from the contract legally because I have an option because it's too expensive, right? The contract is more expensive than the current market price. So forget it. So I will not execute it. But at the beginning, when he entered the contract with Anissa, he would have to pay the option premium or the price of the option. Okay, so that's pretty much the basic concept, right? You see here, contract. So we call this what long position taker, and this is a short position taker, or you can call it option writer. Right? Writer means a seller, right? Option writer or a seller. Okay, so yeah, you have call and put. We'll talk about this soon, but we see some terminologies first. Exercise price. You can call it strike price. So this is the price at which the choice is at stake, right? For example, in our previous instance, the exercise price was how much is it? 1 million, right? $1 million, or a certain amount of money per fish or something like that. But the total strike price was 1 million in our example. Expiration date, when it expires, right? When it expires. So now we have basic difference between European option and American. I hope you're familiar with this, maybe from your previous seminars or classes or anything. So European option and American. So under European system, what is the difference here? You can only execute on the what? On the expiration date, right? Can only execute on the expiration date. On the other hand, the American option allows you to execute anytime before or by the expiration date. So from now on to the expiration date, you could execute the option if you want. Right? Premium is the price of the option. We saw in our previous example, Abian had to pay something to enter the contract because he would be at a more flexible and favorable position, right? He could decide to execute the contract or decide otherwise, right? Just to walk away and do nothing. American and European, we just talked about it. Again, American option allows you to execute anytime by or before the expiration date, right? Before it expires. And then we have, for example, in many countries, especially in developing countries, the availability of the exchange traded options is limited, right? The availability is limited. So we have like more long-term type, right? Long-term equity anticipation securities. Okay, so we call it LIPS. Normally expire more than 1 year, right? Rather long-term than the common ones available on stocks and indices or indexes. Okay, so longer time to expiration. So basically, this is long-term one, right? That's why we call it long-term equity anticipation securities or LIPS, right? So of course in developed countries like in the United States, in Europe, right? In Western Europe especially, have like a myriad numbers and types of options, right? But in developing countries have more limited types and also uh, styles and types or especially the exchange traded options are more limited. So I think it's worth noting as well that in option we also have two types, right? Forward is for negotiated market, right? Futures is exchange traded. So the same with option. So we have the first one is the exchange traded. So this is a similar style to futures in the sense that we have to follow the the regulations and also the sizes, the expiration dates, right, and everything. So you take it or leave it, right? You can't negotiate. But the second one is more forward type. I have the negotiated type, negotiated market. So this is again equivalent to the forward style. So you negotiate your own style, right? So of course, with negotiation, with negotiation, you could change the whatever you want, right? The size of a contract, the expiration date, and so on. Okay, so we're saying that this is less risky. This is not necessarily true, but this is common sense, right? The what's that? Conventional wisdom. Considered as investing more as investing than trading. I mean, if you want to invest, of course, you would consider longer term instruments, right? But if you just try to speculate or trade, you might consider like smaller, the shorter term instruments, right, or contracts. Okay, so before we see the divisions, now we have option clearing corporation for the exchange traded one. For the exchange traded options, of course, you have a lot of the supporting institutions that we also saw in the futures futures market, right? So we have a lot of supporting institutions like the exchange, the clearing house or clearing houses, the guarantor, right? The guarantee organizations. You have the custodians and all other supporting institutions, right? So we have two types of option once again, the negotiated market and also the exchange traded. Okay, so profit and loss characteristics. So now we'll see the two types of option. So we are not going to repeat the logics of doing the derivative transactions, right? In the if you don't remember, please watch again the our videos, right? Two parts of the first instrument of derivative products, that are forward and futures. And so again, the proper use or proper utilization of the derivative products would be for hedging, right? So hedging a mechanism or hedging activity. So you try to protect the value of your underlying asset, your underlying position, or something like that. So uh, again, the main purpose of the derivative, products and markets are not for speculation, right? Not for speculation. But if some people do it for speculation, then that's his or her personal right and personal choice. We just cannot blame the instruments and the markets, right? It's a personal choice. But again, this is for hedging, right? So in the hedging mechanism is very easy. So you do something in reverse, right? So if you're afraid of a certain event or certain fact, you try to go to the derivative market to do something so that if the event that you fear for does happen, you get money from the derivative market or transaction. Very simple, right? So again, one simple example: if you're afraid of a decreasing stock price, then you go to the derivative market, trying to make a contract that if the stock price drops, right, or declines as what you feared for, then you get money from the derivative market. So what position should you take again? It's very simple. If you're afraid of increasing price of something or an asset, then you buy it first, right? So you take a long position. But if you're afraid of a declining price of something, right, then you want to sell it before the price goes down, right? So you take a short position, right? So very simple principle, right? You buy it first or you sell it first. Okay, now for option, we have two types of option, right? The first type is call option. So what is the meaning of call option? Okay, maybe you got it from a previous seminars or classes. So call option means the right to buy. Be careful, okay? Call option doesn't mean to buy, right? But this is the right to buy, okay? The right to buy. So it's a big difference, right? To say buying or the right to buy, okay? They're two different things, right? So call option means the right to buy. So now we want to see each position of it. The first position is long call, right? Long call. So what is the meaning of long call then? Long means to hold, right? To buy, right? To hold or to buy. So long call means
Uh, the
so what's the meaning of long again?
long is to buy, sir.
Yes. So long call means you buy.
The right to buy.
Yeah, that's right. So that's why be careful, right? So long call means the right you buy the right to buy. That's why we don't want to say such a long sentence. That's why in financial world we always say short, short phrases or short sentences, right? So we call it long call, right? So everybody understands. Long call means you buy the right to buy, right? Okay, so let's make an example. Okay, so let's say there's a stock, right? Uh, yeah, not performing well right now, right? So let's say you have an option for BMRI with an expiration of whatever 3 months, right? And again, the strike price or the exercise price is whatever right now. Maybe in 3 months you'll go back to, yeah, hopefully. So 6,000, right? In 3 months. But this is an option, okay? This is the exercise price. Okay, so again, because you're taking the long position, right? Long position means to buy, so you have the flexibility, right? So you buy the right to buy, right? You buy the right to buy. So you have to pay, right? So the price of the option, this is something that doesn't appear in forward or futures. You don't have like one party has to pay a certain price, the other will receive a certain price. That doesn't exist for forward or futures because both parties are committed, right? So they are both committed to executing the transaction. But here, again, the long position taker has a flexibility. That's why you have to pay. So let's say the premium is whatever, maybe uh, yeah, 250 maybe. Yeah, for the sake of example, okay. So 250 a piece, right? This is the price of the option. So when you enter the contract, you have to pay 250 per contract, right? Because you take the long position. Okay, so let's simulate now. Let's simulate, right? So let's say about 3 months later, again, in American option, of course, you can execute anytime, even today if you want, if the price fits you. Okay, if it doesn't fit you, then you don't exercise right away. Okay, so let's simulate, right? About 3 months later, the as is spot, right? You can call it stock price, you can call it spot price. Okay, so let's say the spot about 3 months, within a 3 month time is 7,000. Will you execute the contract? Very simple. Will you execute the contract? You have the right.
No. Yes, sir.
Yes, right? You have the right
Yeah,
to buy at 6,000. Now the spot price about 3 months later is 7,000. Will you do it?
I will do it, sir.
Of course, right? Easy, right? Very easy. So how much profit can you gain? You can buy it at 6,000. Actually, the market price is 7,000.
1,000.
Yeah, so the profit is 1,000, right? Actually, your profit is 1,000. However, when you entered the contract, uh, you had paid, right? You already paid 250 because you took the long position, right? So your net payoff would be 750, right? Net payoff.
750.
Yeah, actually your profit is 1,000, but you had to buy the option because you took the long position, right? You had the flexibility. Okay, so your net payoff would be 750. Okay, so let's change the simulation. All right. What about if the price is 5,500 in the market within 3 months? Will you execute the contract?
No, sir.
No, right? You have the right to buy at 6,000. Now in the market, the price is 5,500, right? Forget it, right? Forget it. What will you do?
By the in the market one.
Right. But I mean, in terms of the contract, what will you do?
Oh, I will short it.
No, you will not do anything. You
Yeah, I
will not
mean,
do
not
anything. Yeah,
gonna do
forget
it.
it.
Yeah, yeah.
Yeah, just forget it. I walk away, right? So you let it go. Let it go. So you do nothing, right? You do nothing. So what is your loss here? You have the contract to buy it at 6,000, but you do nothing. What is your profit or loss?
I will have a loss of 250.
Actually, your profit or loss is nothing. You do nothing, right? You don't execute the contract. However, indeed, right, you paid 250 when you broke the option. 250 per contract when you broke the option. So your net payoff would be minus 250. But actually, your profit or loss is zero. You do nothing. Unlike the forward or futures, you have to do it, right? You're committed to executing, right? So you're committed to executing the contract, but for option, you walk away, so you gain nothing, right? So neither profit nor loss. But you bought the option at 250, so you have paid 250 in the beginning. Okay, so what about now 6,200? Will you execute the contract?
If I have the choice, no. Yes, I will.
You will execute the contract, right? What is the logic
Yes.
here? So look carefully, right? If you execute the contract, right, how much profit will you get?
200, but minus the premium.
That's right. So you gain a profit of 200. But when you entered the contract, when you entered, right, even at the beginning, right, you already paid 250. It's not paid at the end, you know. When you entered the contract, you already paid for it. So your net payoff would be 50, right? Minus 50, right? So negative net payoff, although you actually gain 200 in terms of the price difference, right? But if you don't execute the contract, can you imagine? If you let it
Yeah, we
go,
will have bigger loss.
yeah. If you let it go, right, you gain nothing, but you already paid 250. Okay, so in this case, you still have to execute the contract, right? So what is the principle here? The principle here says that if the spot price is more than the exercise price, you still have to execute the contract. You still have to execute the contract, at least to minimize your negative payoff. All right, so maybe another example. Again, right, 6,200, you still have to execute the contract because the spot price is still higher than the exercise price. What about if the price is what? About 3 months later, 6,000. Will you execute it?
Yeah, because we have nothing to lose anyway.
Yeah, that's my question. Will you execute it?
Yes.
Okay, so let me ask you a question, a very simple question. If you study hard, right? You study hard, you study now in a good spirit, right? You're highly motivated, and at the end you get an A. Okay, this is the first scenario. Second scenario is you are sleeping, you're playing games, and you get an A. Which one will you choose?
Sleeping, playing games, and get an A.
Yeah, that's why this is the same thing here. So you execute the contract, the price is 6,000. You don't execute the contract, you lose nothing. So what will you do? Doing something or not doing something?
Not doing something.
Yeah, of course you're no, okay. So better let it go, right? No meaning, right? You see, this is very different from the case when the price is 6,100 or 6,200 or whatever. If the price is 6,100, imagine that you still have to execute the contract, right? Because you have to minimize your negative payoff. But if the spot price is 6,000, then it has no meaning. Right? If you study, then you get an A. Or if you play games, then you get an A. Of course, you play games, right? Common sense, right? So you do nothing here. Do nothing. Even if you do something, the profit will be zero, right? Of course, you already paid 250. Okay, so let's draw the what's that the profit and loss characteristics for this is long what's that long call, right? Long call. What's the meaning again? Long call?
Long call is the right, the buy to right, buying the right to buy.
Yes, that's right. You buy the right to buy, right? So asset price, and this is your payoff, right? So if you do nothing, what is the maximum uh maximum negative payoff that you pay?
Zero.
No, you already paid the asset the price, right?
Oh, 250, 250.
Yeah, so this is a option premium, right? So this is the maximum negative payoff that could happen to you because if you let it go, you lose nothing, right? But you already paid for the price of the option. And here, right, the yeah, potential payoff would be unlimited depending on the asset price. And here is the exercise price here at this point. Okay, so uh, this is your exercise price, right? And if the price is getting higher and higher beyond the exercise price, then you get more and more from the option, right? Again, this is what's that, a hedging activity, right, actually, right? So if you suddenly go to the market and do this, right, you take a long call position without any underlying assets, that means that you are speculating, right? Speculating. Of course, the downside of doing this could be quite projected because the maximum negative payoff that you could suffer is the price of the option or the premium. Right? Quite clear, right? This is the easiest one, right? Long call. Easiest easiest type, easiest to imagine. Okay, next one. So tell me now, what's the meaning of short?
Selling,
Yep. So what is short call then?
selling the right to buy.
Yes, very good, right? Very good, very easy, right? So you follow, in finance and economics, we always follow patterns, right? You see, once you know the patterns, you could imagine everything quite straightforward. So you sell the right to buy. So short, we call it short call. Right? So you sell the right to buy. So remember, if you're taking the short position, then you are passive, right? You're in a passive position. You don't make a decision. You're waiting for the long position taker to make a decision, right? And then depending on the decision that counterparty makes, you will either execute or not do anything. Okay, so because you are at a passive position, you're in a inflexible position, you cannot make any decision, you don't choose, you don't simply you just wait, then you get the premium. You enjoy that. It's like selling something, right? If you sell something, you get the selling price. If you buy something, then you have to pay for it, right? So as a short position taker, you get the price of the option or the premium, right? So that's the good thing, right? So even before doing anything, you already receive the price of the option or the premium. However, again, you don't have the flexibility, and you have to execute or not execute according to the decision made by the long position taker. So let's going back to our similar example here, BMRI expiring in 3 months with the exercise price of 6,000. Right? So let's say the spot price about 3 months later is 5,800. What will happen to you? You cannot choose, right? You just wait. What will the long position taker do? Will our counterparty execute it or not?
It will not execute it, sir.
The counterparty will not execute, right? So what will happen to us?
We only get the premium.
Right. So we get the premium, right? We already got the premium even at the beginning, right? When we sold or when we wrote the short, right? The short position. Okay. So you get the 250 because the long position taker would not execute the contract, but because you can imagine, right? The counterparty has the right to buy this from us, right? So you sell. Let me refresh my statement again. So the short call, right? So you sell the right to buy BMRI at 6,000 for 3 months, right? So you sell the right to buy BMRI from you, right? You sell the right to buy BMRI from you at 6,000 for 3 months. So after 3 months, the spot price is 5,800. So of course the counterparty will choose not to execute the contract, right? Because the guy has the right to buy from you at 6,000, and in the market is 5,800. Right? Definitely the guy will not execute the contract. So he or she will let it go, right? The counterparty will let it go. Just again, the counterparty will just walk away, and you lose nothing. But in the beginning, you already earned 250. Another example, let's say the spot price. Spot price is 7,100. What will happen to you?
The counterparty will execute the contract, and we'll get the premium and the 6,000 of the short call.
Yeah, that's right. So what is your profit or loss? The guy has the right. Yeah, the institution has the right to buy from you at 6,000, but in the market is 7,100. What will happen to you in terms of the profit or loss?
We got a profit of 6,250.
Think about it again, right? You sell the right to buy BMRI at 6,000, right? So in the market is 7,100. Are you happy or unhappy? You already sell the right to buy from you at 6,000. The market price right now is
we're not
7,100.
happy. Yeah.
Yeah. So how much will you lose?
We'll lose 1,100.
Yeah, that's right. This is your loss, right? Actually, right? But at the beginning, because you wrote the contract, you sold the contract, you already got 250. So your net payoff would be whatever, 850. Okay, so
Yes.
you just wait, right? You cannot do anything. You just wait. But in this scenario, you are badly unhappy because of 7,100. That's the spot price. But you already sold the right to buy from you at 6,000. So let's continue. Maybe anything. 6,250. What will happen to you?
We'll get nothing.
Yeah, but will the counterparty execute this?
Yes.
Yes, of course, right? Again, you sell the right to buy. Sorry, you sell the right to buy BMRI at 6,000, right? It turns out that the spot price 3 months later is 6,250. So the counterparty will definitely execute this contract. So you're losing what? 250, because you have to sell to that institution at 6,000, right? Now the market price is 6,250. So you're losing 250. However, at the beginning, because you sold the contract, you already got 250, right? The option premium. So your net payoff turns out to be zero, right? Although you're losing 250, but you sold the contract for 250. Okay? So let's look at the payoff characteristics now. So what's the maximum payoff that you could get? If your counterparty does nothing, how much will you get for payoff?
250, sir.
250, yes. So this is the maximum, right? The premium that you would enjoy. Right? So it's simply a mirror, right? You see? It's a mirror, right? Okay, so the maximum net payoff that you could enjoy is the price of the option or the premium, but your potential loss would be unlimited, right? Depending on the asset price. If the asset price keeps going down, then you lose more from this transaction. But one more time, this is what? This is a hedging mechanism, okay? Supposedly a hedging mechanism. So you do this because you have an underlying cause. You have an underlying transaction or asset. Quite easy, right? Now you can imagine easily. Every time you look at the long call or short call, you see the logic, right? Very simple, actually. And of course, if you haven't done it, I mean, in terms of the theoretical knowledge or the practical experiences, then you might get a bit confused, right, in terms of the terminologies. But once you do it every day, this would be like just peanuts, very easy. You keep doing it. Okay, so now the second type. What is put option then? Was it the right to do what? The right
The right
to
to sell an
sell.
asset.
Yeah, to sell anything, right? Sell stock or any type of asset. The right to sell, right? Put option means the right to sell. The right to sell, okay? Not to sell, okay? Be careful. Put option means the right to sell, not to sell, eh? Now we have two possible positions as well. You see, it's more exotic, right? Under forward or futures contracts, you only have long and short, right? Long and short. Now you have four possible positions, right? You have long call, short call, and now the third one is long put. What is the meaning then?
Buying the right to sell.
That's right. Easy, right? So you buy the right to sell, right? You buy the right to sell, right? So you're buying the right to sell something. Imagine, right? You're buying the right to sell something. And of course, we'll maintain our example, right? Make it a smooth continuation. Now you take long put, right? Long put, right? To buy the right to sell. So you buy the right to sell BMRI at 6,000 with an expiration period of 3 months. And of course, the premium of the option is 250 in our example. So let's say about 3 months later, the spot price is 5,300. Will you execute it? Remember, you're taking a long position. You have the right to execute. Will you execute it or not? You have the right to sell at 6,000. right? You have the right to sell at 6,000. Now the spot price is 5,300. Will you do it?
No, sir, I think.
Right? Think about it again, right? You have the right to sell at 6,000, right? You have the right to sell at 6,000. Now the market price is
Oh, yeah.
5,300. Yes or
Okay, okay.
no?
Yeah. I will execute it.
Yeah, of course, right? Of course, right? You have the right to sell at 6,000. Now
Yeah, yeah, yeah.
the market price is 5,300. Will you do it or not? Yes or no?
Yes.
Yes. How much profit will you get?
I get
The profit.
700.
Yeah, the profit is 700. That's right. However, again, you're taking a long position, right? So when you entered the contract, you already paid 250. Okay, so your net payoff would be, what is it? 450, right? Easy, right? So you have the right to sell 6,000. Now the price is 5,300. It's like short selling, right? It's like short selling in stock, you know. You have the right to sell something within 3 months, right? So let's change it. What about 6,500? What will you do?
No, I will not execute it.
That's right. Imagine again, you have the right to sell at 6,000, right? You
Mm.
have the right to sell at 6,000. Now the market price is 6,500, right? Will you do it?
No.
No, right? Why
Yes.
should you sell at 6,000? Right? Why should you sell at 6,000 knowing that the market price is 6,500? Right? So yeah, unless you have anything, maybe a romantic relationship with the counterparty, right? That's a different story, but yeah, a logical person will not do it, right? Will never do it. So what will you do?
I will not execute the contract.
Yeah, you let it go, right? You let it go. You do nothing. So what is your profit or loss?
I get a loss of 500 and a net payoff of 750.
Not really. Remember, you do nothing, right? So you have the right to sell at 6,000. You have the right to sell at 6,000. Now the market price is 6,500. You will not do it, right? You will walk away. What is your profit or loss? You say
Oh, yeah,
goodbye?
200, 250.
Yeah, but your profit or loss is?
Zero.
Yeah, zero. You do nothing. You walk away, right? This is not forward or futures, right? You have the choice, right? And you choose not to do anything, right? You just walk away. You say goodbye. So your profit or loss is actually zero, right? But again, you broke the contract. In the beginning, you broke the contract at 250. So your net payoff would be, yeah, minus 250, right? Easy, yeah? Okay, so 5,900. Will you do it?
Yes, I will do it, sir.
You will do it, okay? You have the right to sell at 6,000. Right? You have the right to sell at 6,000. Now the spot price is 5,900. Will you do it again? One more time. Will you do it? Yes or no?
Yes,
Yes. How much profit will you get? You have the
100.
right to sell it. Yeah, you have 100 profit. However, you paid 250 when you bought the option. Your net payoff would be, okay? So be careful, right? As long as the exercise price is higher than the spot price, you will execute the put option. Okay? At least to minimize your payoff, right? Minimize your negative payoff. Imagine in this case, if you decide not to do it, if you don't do anything, right, you let it go, you gain nothing, but you suffer the what's that? The option price, right? The price of the option, 250. Okay, so you still have to do it, right? As long as the exercise price is higher than the spot price, then you will have to execute your put option. Simple, right? For call option, S higher than X. For put option, X higher than S, right? Is the condition where you have to execute the contract. What about 6,000? What will you
No,
do?
I would not execute it, sir.
So studying or playing games?
Playing games.
Okay, good choice. Okay, so you do nothing, of course, yeah. But if you do something, the same, right? So once again, studying or playing games?
Playing games.
Okay, playing games, good. Okay, so this is what put option, right? Put option. So let's throw it somewhere. Oh, ugly picture. Asset price, payoff. So what is the again? What is the maximum negative payoff that we could suffer if we let it go?
Negative 250.
Yes. So this is the premium, right? This is the maximum. If we do nothing, we let it go. This is the maximum amount that we could suffer, right? But if the asset price keeps declining, then we will gain more. Right. So, and this is the exercise price here. Easy to imagine, right? You see, if the asset price keeps decreasing, then we'll get more. Imagine like we have the right to sell at 6,000. If the price is at 5,000, 4,500, then wow, you get more and more from the contract, right? Okay, now the fourth position. This is the most awkward position. What is short put?
Selling the right to sell.
Yeah. So imagine, right? Now you sell, right? You sell the right to sell something to you, right? Yeah, you sell the right, right? You sell that. So again, as a short position taker, you have no choice, right? I mean, you just wait for the decision made by the long position taker. Right? Imagine how you short put, right? Short put. So you sell the right to sell BMRI to you at 6,000 for 3 months, right? For the range of 3 month period at 6,000, right? And the premium is 250. So because you sell the contract, you write the contract, so you get the option price of 250 in this example. So think about it again, right? You sell the right to sell BMRI to you at 6,000 for about 3 months, right? So let's simulate again. 3 months later, the price is whatever, maybe 7,000. What will happen to you? You just wait, right? So what will happen to you depends on whether the counterparty will execute or not. Think about it. You sell the right to sell BMRI to you at 6,000, right? Or the market price is 7,000. Will the guy do it? Will the other guy do it?
No.
Yes or no? No?
No.
Because the other institution has the right to sell to you at 6,000. Now the market price is 7,000. Will the institution do it? The other institution?
No.
No. So what will happen to you?
We get a 250 loss.
That's right. Why loss? Now you sell the contract, right? You sold the contract, then you got the option price. You sell the contract, right? You get the option price. So obviously, what you get the price, right? You get the option price because you are selling. So one more time, right? You sell the contract, right? You sell the right to sell BMRI to you at 6,000 within 3 months, right? Now it turns out that the market price is 7,000. So the counterparty will not do it, right? Because the counterparty has the right to sell. So the guy or the institution has the right to sell to you at 6,000 because you sell the contract, right? You sell the right to sell to you at 6,000. Now it's 7,000. So the counterparty will do nothing. So you gain nothing, right? But you already got the price at the beginning, remember? You sold the contract. You sold the contract. So you are entitled to the option price. Okay, so this is the most awkward position, right? You sell the right to sell. Another example, 6,500. What will happen to you?
The counterparty would not execute, and we get 0 plus the premium.
That's right. Very good, right? So you sell the right to sell. No, you sell the right to sell BMRI to you at 6,000, right? And the market price right now is 6,500. So definitely the counterparty will not do anything, right? Because the counterparty has the right to sell to you at 6,000. And he or she or they will not execute it. So we gain nothing, we lose nothing, but we already got 250 in the beginning. What about this?
We get a loss from the counterparty who executed 250 and get a profit from the premium 250, so we get 0.
That's right. Think about it again, right? You sell the right to sell BMRI to you at 6,000. Now the market price is 5,750. Definitely the counterparty will execute, right? Because the counterparty has the right to sell to you at 6,000. Now the price is 5,750. Right? Again, right? So because the counterparty will execute, then we will lose 250. Right? Remember, we sell the right to sell to you, right? So we sell the right to sell to us at 6,000. Right? So we suffer from a 250 loss, right? Because we sell the right to sell to us at 6,000, while the market price is 5,750. However, in the beginning, we sold it at 250, right? This is the option price. Then the net payoff would be 0. Easy, right? Very easy. Now go back to the. So what is the maximum payoff we could get?
250.
That's right. So this is the option premium. If our counterparty does nothing, right? So we'll get that much. But if the asset prices keeps going down, we'll be in trouble. Right? But again, this is like a hedging activity, right? But you'll be in trouble if you're having a naked position and this happens to you. Naked position means you don't have any underlying transaction, any underlying cause, and suddenly you are taking this position, right? Just for speculation. Okay, so very easy. There are mirrors to one another, right? Mirrors to one another. Long call and short call. This is what long put and short put, right? Okay, very easy. Now you're supposedly experts in option, right? Now, very easy. Just need to put into practice. Start trading option, right? For your own company, for your own account, or something like that. We have seen this. So now we'll see time value of money and dividend. This will affect, of course. This is more advanced calculation, but again, in the modern ICT, information and communication technology, this could be incorporated quite easily. Just put into Excel, and we have to adjust anything, right? Adjust the time value of money. Actually, we are going to see it in a while, in a little while. Option characteristics. Again, you see, when we did the simulations, the main purpose of doing that is for you to understand the logics, okay? Instead of memorizing. You see, if you memorize, you see, like, oh, long position, limited risk, unlimited. This is like you will forget it quite easily, right? Quite fast. So when you do the simulation, you try to stimulate your brain, right? You stimulate your brain to think about the what's that, changing positions, and then changing prices or something, so you understand more. So I would not suggest you to memorize. Of course, you could, when you do it more and more, you will memorize it by accident, right? You just unintentionally memorize things because you have been doing this, right? Okay, very easy. Now this is what we did, right? You see, it's for the long position taker, for long call, right? Long call, maximum net payoff, negative net payoff is the what's that? The premium and unlimited profit. Just remember the figure that we saw, right? Now we are seeing the option trading strategy. First one means what? Naked strategy. What does it mean again?
You don't have the underlying assets on when you
That's right.
on the conditions of
That's right. You
options
speculate,
trading.
right? You speculate, right? You're thinking again from our discussion in the previous videos, right? Uh, Speculation is quite appalling, like quite compelling, especially in the hardship of life. In maybe some of your parents are entrepreneurs. You can ask your parents. Right? It's quite stressful, right? Have to fight against competitors. Uh, you have to think about new strategies all the time. You have to make what's that, networking with the government officers, with business partners and everything. So it's quite quite stressful, right? Uh, yeah, many entrepreneurs get stressed out, and that's why they go to like exotic places, like yeah, you know what, right? So to cool down a bit. But it's very stressful job, right? But with speculation, you're thinking that no, the chance is 50-50, right? It's like playing baccarat. If you go to casino and you play baccarat, then you only need to choose what, blue or red, right? Banker or player, banker, player, banker, player. So similar to that situation. So you think that the chance of winning is not that bad, right? 50%. But if you think about it, right, 50% is a very bad chance, right? Because your chance of losing is 50% as well, or maximum 75%. If you play baccarat, the maximum chance of winning is 75%. But the chance of losing 25% is very big, right? Very big. And even that's with the assumption that uh the chance per play is not random, but actually it's random, right? So what has happened yesterday, what has happened in the previous what was that, previous round, previous shoe, uh is independent, right? Independent of what will happen now. Right. Okay, so it's similar thing here. So speculation is always dangerous, and that's not the main purpose of having the derivative markets and instruments. And the second one is, of course, for hedging, right? For hedging. Now we have, for example, two simple positions like covered call and protective put. So covered call, so easy to draw this one, covered call. So covered call is not a recommended move, right? Not a recommended move. So it's still useful, but it's not recommended, right? So it's like, yeah, anything you could imagine that you could buy maybe as a football team manager, right? In a manager game, you could buy any player, right? You could sell any player, but this is not a good move, right? So let's imagine if you have a portfolio. If you have a portfolio, will you be happy if the portfolio value increases or decreases?
Increases.
Increases. So let's say you get it at this price. Okay, so you start your portfolio of assets at this price, right? So if the asset price or asset prices uh, keep going up, keep increasing, then this is no problem, right? You'll be happy, right? You'll be just happy. And what will make you unhappy is this. Agree, right? So this range will make you unhappy. It's going down, right? The price is going down. So what can you do? The first strategy is what we call covered. So yeah, covered call, right? So it means that while having a long position in your portfolio, you're taking uh, you're taking a short call position. How do you draw short call again? Short call? Short call? What is the maximum payoff can you get if you short call?
250, sir.
Yeah,
I mean
premium.
the premium.
Yeah, that's right, the premium. Yeah, so it will look something like this, right? I know the picture is bad, but I hope you can imagine, right? So because I'm writing on the screen, so it's quite difficult to do it beautifully. Oh, yeah, but I hope you can imagine whatever here maybe. Okay, so you see, well, if if the asset price or the portfolio value is going down, hopefully you earn something from the what's that, the short call, short call position. But if the your portfolio value is doing well, but it has to be compensated by the loss in your short call position. That's why this is not recommended, right? This is not recommended, right? Because you see when you gain a lot from the portfolio value, you got a lot of capital gains. You have that has to be compensated or has to be what's that, cancelled out. This is a trade-off, right? It will be cancelled out by the loss that you suffer from the short call position. However, if you suffer a lot from this, the maximum benefit or profit or payoff that you could get from the short call is only the premium or the what's that, the option price. So not recommended, right? Not recommended. It's still useful, right? But not recommended. And in several countries, uh, short position is quite limited. Okay, for example, in I think in UK, uh, well, I'm not sure, because I didn't live in the UK for a considerable period that I can speak for it. But in the US, in the US, if you want to take a short position, you need to get a permission, because you need to have an argument why you are taking a short position. Why? Because you see you see the possibility here, right? Oop, yeah, here. More dangerous, right? Every time you take a short position, your possible loss, right, or possible losses would be quite considerable, quite significant, right? See this is short position, right? And for this one, it would be this one. Okay, so in the United States, you must have a reason as to why you take a short position. But for the long position, it's free. You can speculate freely if you want, right? You can speculate, no, or hedge using the long position without any reason. But for short positions, you need arguments or reasons as to why you are taking the position. Right? I think in the UK is even stricter, but I'm not sure. I cannot speak for that. Uh, so going back to our discussion here, where is it again? It disappeared. Maybe down there. Okay, here. Sorry. So the covered call position, although it's still useful, is not recommended. Right? Recommended. Now the second one is more recommended, the protective put. Protective put, right? So actually similar situation. You're having a portfolio. Okay, you're having a portfolio, and this is your asset price. This is your payoff. Once again, right, you will be happy if your portfolio value or your asset prices increase. No problem, right? You'll be unhappy if it goes down, right? Your asset price goes down. Okay, now protective put means you're having a long position in your portfolio and hedge it using long put position. How is long put again? Long put. Long put. What is the maximum loss or a maximum negative payoff?
The premium.
Yes. Long put will look like this, right? Okay. And if the asset price or portfolio value, oh, really bad. You understand what I mean, right? The picture is bad, but oh, this is supposed to be a straight line, right? Okay. So again, the maximum negative payoff, and then yeah. Okay, so see the logic there. If you lose money from the decreasing value of your portfolio, you earn from here. You earn from your long put position. And on the other hand, if you are doing well in your portfolio, right, the asset price or portfolio value increases, you have to pay your what's that your option premium, right? Option price or premium. So this is the recommended one, right? It's more recommended than covered call, right? So protective put is more recommended than the covered call because in the covered call mechanism, you have to short call, right? But for a protective put, you will long put, right? So safer and more, yeah, more prospective as well, right? Okay, so we have straddle, and then we have combination, right? So straddle is like, and this is the more complicated one, strip and strap. Okay, so straddle means you are taking, oh, straddle means you are taking an opposite, uh, you are taking opposite positions, uh, but at the same exercise price and the same expiration date. So for example, you're taking a long straddle. Long straddle means long call and long put at the same time, right? Long call, long put with the same exercise price, with the same expiration date. And short call, of course, is short call and short put, short straddle. It yeah. So how you can imagine? So long call. So tell me long call. What is again the maximum net payoff? Negative payoff,
The premium again, sir.
right? The premium. Sorry. Long call look like this, right? Okay. This is the exercise price. What about short call?
Short
That's
call is
right. Long straddle means long call and long put. Okay. So long call, long put. That's why we call it long straddle. Right? Just taking what's that? Uh, Opposite types of option. I should rephrase my statement. Right? The opposite types of option, right? So long call, long put. So how is long put again? Long put.
from the right side.
Yeah.
The
Maybe I use another
get a
color.
negative premium.
That's right. Like this, right?
Yes.
Mm. Okay. So because of the canceling out, right? See here, we can cancel this out. So now it will look like this, right? So you see, what is the main purpose of long straddle? Long straddle will give you money if the asset price is below, what's that, below this point. I'll use another color here. Oh, let's see here, or beyond this price. So you get money either way, right? So if the asset value or portfolio value is beyond this level, you get money, right? See here. Or if this is beyond a certain price, you gain money as well. Can you imagine what kind of transaction is it? Maybe the interesting one right now, the oil price. You see, if
Oh yeah.
you're an oil company, you are unhappy if the price is like this, right? Like it is right now. You're sad, right? But you are also unhappy if the price is too high because there will be what's that? Fewer buyers and less demand, right? So either way, so you try to do it, right? If the price is too low, you get money from the option, from the straddle, right? Long straddle. But if the price is too high, then you suffer from less demand. You also earn money from the long straddle. Easy, right? Easy to imagine. You just need to find, the same expiration date, same exercise price. If they are not the same, if the exercise price is different, then we have a bit, we call it combination, right? The combination strategy. For example, here's the exercise price for the first one. But when you do the long put, you are unable to get this one, but maybe here, something like this. And so this is your, so you have different exercise price. So you don't you don't match this perfectly, right? So you have the yeah, a bit adjustment for calculation. You don't match them perfectly. That's natural in business, right? We can calculate everything. This is called what? This is called combination. But this is straddle, right? Straddle. So what about short straddle? Tell me short straddle.
Putting both short call and short put.
That's right. So what about short call? Like this?
Yes, from the and then the short put from the right to left.
Yeah, short put, look like this. They have the same exercise price, right? For the straddle. This is short straddle. So short call and short put. So this is more difficult to imagine, right? So you see, you get money if the asset price or the portfolio value is between this point and this. All right. You get money here, right? But yeah, if the price is below this amount, then you lose from the option, and vice versa, right? On the other hand, if the price is beyond this point, that you suffer loss also from this option. So obviously, in the main transaction in its main business, this hedger doesn't like doesn't like a stable price, right? So in the real world, this guy or this company may not like the stable price. That's why uh, the organization or the company is doing something so that if the price is stable, it will get money from this option. But if the price or the prices are volatile, they're happy enough in the real world. Maybe I cannot think about the no any example of this, but I mean this is possible, right? Possible to do if we want. So this is called what? Short straddle. This is long straddle. And if you don't have the such as this one, you don't have the perfect match for exercise price and expiration date, then this is called what? Combination. Combination. And we have strip and strap. This is something more complicated. I think strip or strap. I don't claim to know everything. Okay, so because I haven't done these transactions before, strip and strap. So it's like using maybe 2 puts, 1 call, or the other, or maybe the other way around, right? Maybe 2 calls and 1 put. Yeah, some combinations like that that you can look further when you go into anything like a securities firm or hedge fund company to work or to manage in the future. So strip and strap. So we are using like different numbers of option contracts. One of the main purpose is to reduce the cost. Remember, if you take a long position, you need to pay, right? If you take a short position, then you get money from the option price. So by doing this combination, you might be able to reduce your contract cost. Because if you think about it, right, contract cost could be quite expensive. If you do maybe let's say you are doing 1,000 contracts, and option price per contract is like maybe $500, right? So with 1,000 contracts, you already have to pay like 500,000, right? The option premium or the option price. Of course, it benefits the company in the sense that it protects the value of the underlying assets. But still, right, the price of the option is not cheap if you buy a lot of contracts. So by doing strips or straps, you can maybe minimize the cost by taking what's that, the counter short position, right, to gain some money from the selling of the option. Okay, we've seen this straddle combination. Now option valuation. Okay, option valuation. So we have several terminologies now. So for the call option, still remember the principle. You will still execute as long as the X is higher than X. Right. So if the position is executable and profitable, we call it what? In the money. Right? So if S is still less than X, then what's the name then? Can you imagine? In the money, what's the opposite? Out of, right? Out of the money. Right? But if it's still perfectly similar, then what's that? At. Right? For the call, right? Call option. So the opposite position, the put, right? Put, as long as X, the exercise price is higher than spot, then we call it what? In the money, right? This is for the what? Put option. And if X is less than S, this would be what? Out of the money. And then if X is equal as, it will be at. Okay, so this is the this is the logic, right? The call and put. Right? So again, for call option, just remember S is higher than X, then you execute it. Right? And for the put option, X should be higher than S to execute the option. Okay, so we'll talk about the first method to value an option. We call Black and Scholes, right? Black and Scholes option pricing model. If you are French, then Black and Scholes, right? If you are American or British, then this is Black and Scholes, two names, Fisher Black and Myron Scholes. And they published this paper in 1973. Right, 1973, Scholes got got Nobel Prize, I think in maybe 1990. Fisher Black was never awarded the Nobel Prize because he passed away before he got the Nobel Prize. So again, Nobel Prize couldn't be awarded posthumously. But I mean, if Fisher Black had lived by 1990, he would have been awarded the Nobel Prize as well, because this is part of their joint effort, the Black and Scholes OPM. OPM, this option pricing model, right? Black and Scholes option pricing model. Okay, so see the variables first, right? Call and put. Stock price. Can you imagine stock price? What is call again? Call?
Is to buy, sir?
No, not to buy. Be careful. Call means
The right to buy.
yeah, the right to buy. And put is
The right to sell.
yes. So you can imagine, right? If stock price increases, then it will affect the call price positively, right? Because you have the right to buy. Remember, right? You have the right to buy. You have the right to sell. Right? So increasing stock price will affect call price positively, but the opposite for put option. What about exercise price? This is X. This is X. Exercise price. This is the price at which you can execute the contract. Of course, the higher the exercise price, the more difficult for the call option to execute. Imagine, right? If the exercise price in our previous example was 6,000, you can execute it if it's above, right? So if we increase the exercise price, it's getting more difficult for the call option, the long call position to execute. But the opposite for the put option, right? The higher the exercise price, right? The more profitable would be for the long put position taker, right? Because they could sell it higher. For this one, right? They could sell it higher. So the higher the exercise price, the higher the chance that the long put position taker will get profit. Right? Time to maturity, right? The longer the option is, the higher the value of the option, right? Because we have more time to wait, right? We call it time value. We'll see in a while. So time value means you have more time to wait. For example, if your option expires next week, right? Then you have a very short window, right? Very little window to wait. But if the option still lasts for maybe 3 months, anything could happen, right? You still have a lot of possibility and chance to get the profit from it. Stock volatility as well. If the stocks are sleeping, then it's useless, right? Imagine you buy what? BUMI. Do you know BUMI?
No, sir.
BUMI stock?
Yes, sir.
Yeah, the 50 penny, right? And it's sleeping all the time, maybe forever. Then it's useless to do any option on BUMI. BUMI. So what about interest rate? This is positive, and for put is negative. We'll see this in the formula. Okay, it's quite technical for this one. And cash dividends. Then you have to watch the video on dividend policy, because every time you pay dividends, then your stock price will decrease by the amount of the dividend per share. That's just natural, right? If you buy, if the company announces like dividend payment, usually because of the amount of money they have to pay out, they have to distribute to stockholders. Usually, the stock price will decrease by the amount of dividend per share. That's why the call option, right, decreasing stock price a bit. So this would be negative, right? And for put, this will be positive. For this one, we have to see it in the technical calculation. Okay, so now let's see this one, Black and Scholes, right? Black and Scholes option pricing model. So maybe quite we write it down slowly so you can look at it. So call price, right? Look at it and maybe memorizing a bit step by step. So the call price, what is it? S, what is S again? Stock price, right? Stock price multiplied by the, we call it CDF of D1. CDF is cumulative distribution function, right? Cumulative distribution function, the CDF in mathematics, right, is the cumulative distribution function of D1 multiplied, right? Then minus the exercise price. This is exercise price, right? X divided by the E, no E, 2.72, right? To the power of R. R is interest rate or risk-free rate. Usually it is proxied by risk-free rate, T. So you could write it here if you want. Remember in your mathematics, right? You can write it this way. Or yeah, it's whatever style you want, right? Okay, times the CDF of D2. CDF is a cumulative distribution function. So what is D1? So D1, we have to solve the D1 first, right? D1 is the log. Log here means natural log, right? As always, right? It's very rare with saying the other type of log. So this is always the natural log of spot price divided by exercise price, right? Times the interest rate plus half of the variance of the asset return or the stock return, right? Multiplied by the time in year, right? Time in year. And what about the D2? Right, D2 is D1 minus standard deviation. Be careful, this is variance. Here, this is variance, right? This is standard deviation multiplied by the square root of T, time. Okay? And then knowing the call price, according to the Black and Scholes option pricing model, we can estimate the put price. Put price would look like this: the exercise price divided by E to the power of RT minus the spot price plus the call price. Okay, so yeah, write it down. Maybe you can follow step by step and yeah, memorizing a bit. Okay, but even if you don't memorize, it's okay. You can watch this video again, or you can go to Google to search, and yeah, easy, right? Modern times. Okay, so we'll put this into an example. Okay, so see an example here. Stock price is 20, the exercise price is 20. The interest rate as proxied by risk-free rate is 6.4%. Option period is 3 months, so be careful. 3 months means in year 1/4, right? A quarter, right? Of course, be careful. And the standard deviation is 0.4. Okay, now tell me. First, we have to determine the D1, right? Tell me how to do it again. D1 log of what? What is it?
Log
S,
of stock
right?
price.
Yeah, S, and this is what?
Exercise.
X. This is log, right? Be careful. Log of S per X plus what is it?
It's the derivative.
No, the interest. What's that? The interest rate, right?
Yeah, the interest rate. Sorry.
Oh, and what is it? This is half, right? So, wait, half of what? This is half of what? What is it? Standard deviation squared. What is the name? What is standard deviation squared? Squared standard deviation is?
Variance.
Yeah, variance. Yeah. So see, this one square, right? Is this. And then what is it?
That's the months.
Yeah, time in year.
Time period.
A quarter, right? Okay, what is it? Hey, what is it? Standard deviation, right? And what is it?
The time period.
Yeah.
Sorry.
Square root of t, right? So this is the standard deviation, okay? And then the square root of 0.25 is 0.5, right? Square root of t. Okay, then we get yeah. I've calculated for you, so you get this. This is the D1, right? D1. So what about D2 again? D2 is D1 minus, what is it?
It's the standard deviation times the square root of time period.
Yeah,
yes.
square root of time. That's right. Right, square root of time. So you get minus 0.020. Easy, right? So once you get the D1 and D2, you put into the main calculation, right? So look at it again. Now you get D1 and D2, right? Now you put into this, right? What is your S again? Your S?
0.4.
No, your spot price.
Oh, what price? $20.
Yeah, 20 times. Yeah, now you need this, right? The CDF of your D1. What is your D1? We just saw your D1 is 0.180. So we need Excel. Yeah, of course, you're not going to find in the table, right? This is modern times, okay? You have Excel. You don't bring statistical tables in your wallet, right? That would be crazy. Okay, so we have, what is the D1? 0.80.
0.180.
And what is the D2? Can you tell me the D2 minus what?
0.020.
0.20. Okay, so we just need to norm as this. Easy, right? Even cats can do it. So just copy paste to this one. Okay. So norm as this. So what is it? Times. Okay. So 20 times. What is it again in Excel? 0 point something, right? 0.571, and then minus, what is the X?
20.
20. What is the E? What is E again? To be precise, 2.718 something. This one, right? 27183. To the power of, what is R?
The interest.
Our R? Yeah, what is it in our example?
The 0.4. No,
6.4.
I forgot.
Is it 6.4
Yeah.
times what? T.
0.25.
Yeah. Multiplied by the CDF of D2. We just calculated in Excel. Here, this one.
0.4 something.
Yeah. Okay. Okay, so we get here, this one. So 174, okay? So 174 is the fundamental value of the call option in our example, okay? Easy, right? Just put this, even if you don't remember the formula, you can always go back, can check your, what's it, video or Google or anywhere, very easy. So by putting your inputs into the formula, then we get 174. This is the fundamental value of the call option. What about the price and the put? Remember the put, we wrote it down also here, the put. Okay, so, we forget to discuss this one, D2. D2 is easy, right? D1 minus, so the D1 minus, is that the standard deviation at 0.4 times the, and we got,
0.25.
and then actually we calculated it already, right? So, okay.
Yeah, we already
Yeah, that's right.
minus that.
Okay, so so by knowing this, the fundamental value of the call option, we can estimate the fundamental value of the put option. Right? So what is our X in this example?
The exercise price. It's
20.
it's 20. It's 20.
20, that's right. So E 27183 to the power of, what is that again? The R 6.4, is it?
Yes.
6.4% times T.
0.25.
Yeah. Then minus, what is the spot price? 20,
The
right?
stock price. Yeah,
Yeah,
20.
in this, be careful because both of them are 20. Bad example, but plus the call. What is the call? 174, is it? Yeah, 174. Yeah, so I have calculated for you as well, and the result is so I'm using this style. It's just the same. You can use this style if you want. Just the same. Okay, so the fundamental value of the call option is 174, whereas the fundamental value of the put option is 68 cents. Fundamental value, okay? Fundamental value doesn't always mean the real option price in the market. You know, right? For example, if you have been studying portfolio theory this semester, when we determine the fundamental value, it doesn't necessarily, or it's not necessarily translated into the real market price, right? Because there are other factors. Okay, so what are the factors now? Look at this. So the real price of an option, right? The real price of the option is this, right? So let me. So the real option price would be, of course, the one that we just discussed here using the Black and Scholes option pricing model. The what's that, fundamental value that we just saw, right? Using the Black and Scholes option pricing model. But we have one more component, very important one. We call time value. So time value means you have this option carries additional value because it offers you the time to wait. Because you have the time to wait, anything could happen, right? Anything could happen. So to show this easily, let me show you this example. Oh, okay. Look, this is option on a stock, right? And the stock is Alcoa. Alcoa is like aluminum something in the US, right? Very famous company, Alcoa. And you see here some quotations here. Several several X or stock prices that you could choose, right? And there are a lot of expiration dates, right, that you could choose, right? Depending on your interest, right? Your hedging interest. But this is exchange traded option, right? So in the negotiated market option, you can negotiate anything, right? As we have discussed, right? This is an exchange traded option. So you have to take it or leave it, right? Take it or leave it. So look carefully now. Let's imagine this one. You see? So this is the S, right? This is the X. So the spot price right now is 42.7 per 8. So 42.78, right? And the exercise price is 40. Now imagine our example, right? You have the right to buy at 40. And the price right now is 42.78. Is it in the money or out of the money? Will you execute it right now, actually? You have the right to buy at 40. Right? You have the right to buy at 40. And the current price, the real market price right now is 42.78. Will you do it? Is it in the money or out of the money? Of course, it's already what? In the money, right? It's already in the money, right? In the money by how much? Think about it again, right? You have the right to buy at 40. The current market price is 42.78. So actually, even today, you could execute the contract and get the fundamental value would be 278. Agree, right? This would be the theoretical value, at least the theoretical value of the option. But look carefully. What is the price? What is the real option price? In April? In July? Okay, so it's higher than this, right? So let me write down here again. Show you in the blank page to make you more focused here. So you have the right to buy at 40. The exercise price is 40, right? And the current price right now is 42.78. So you see, even now, if you do it today, you have an immediate benefit of 278, right? So this would be the fundamental value of the option. However, if you look carefully, the price of the option is not 278, but 358 for July and for April, and 4.25 for July. 4.25 for July. It's more expensive than the fundamental value, right? So the gap, right? The gap or the difference between the fundamental value and the real option price is called the time value. Okay, so you see this one is April, right? April. And for July, the price is even higher because now you have more time to wait. You have more time to wait, right? So the fundamental value is already 278, but the real option price, you see, for the execution in April, this is 358. For the execution, for the expiration date in July, this is 4.25 because the longer the time you have, the higher the chance that everything would change and the profit might be higher, right? So look at the this is even more interesting, like the put option. So tell me right now, right? We're using the same example, this one. So if you have a put option, you have the right to sell at 40. You have the right to sell at 40, right? And right now, the price in the market price is 42.78. Can you execute now?
No.
No, right? You have the right to sell at 40, but the current market price is 42.78. So this is still what? Out of the money, right? Out of the money. It's still not profitable if you execute it today. So what is the fundamental value? Zero. It's out of the money, right? If you execute it, you don't gain anything and even you lose money, right? You have the right to sell at 40, but the current market price is 42.78. So you will not do it, right? So the fundamental value is zero. But look carefully, look carefully. In April, for execution in April, the price is 7.16, not zero. It has a price. Why? Because you have,
Because of the time.
yes, you have the time value, right? So the fundamental value is zero because it's worth nothing, right? If you do it today, you don't gain anything. You're losing money. So it's still out of the money. So the fundamental value is zero. But you see, the real price in the market is not zero, but still 7.16 because you have the time value. Okay, so again, we have two components that make up the option price. First one is the fundamental value that we uh, estimated using that we just saw right now using the Black and Scholes option pricing model. And the second component is the time value, right? Because you have the time to wait. And the longer the time you could wait, the higher the time value would be, right? Okay, so you have stock index option in the United States, they have everything, right? So the interest rate options have the index option, and then option on stocks, right? Option on bonds, uh, and some exotic options, right? The weather index, weather index option. So you can make sure you have even you could make an option contract on the weather index, right? Whether you bet on the uh, more was that hotter weather or cooler weather or something like that, right? Especially for energy companies, you have a uh, big interest and important contract to make in the weather index futures or weather index with weather index options. Uh, yeah, everything. In Indonesia, we have the option on stocks. We call it KOS. KOS. So option on stocks, and very limited types of options available in developing countries. Okay, so to end this session, I will show you the second method. Okay, uh, second method to estimate the fundamental value of an option. This is called what, binomial model. A binomial model is a real option model. So to understand more about real option, you can watch my video also on real option. This applies the same principle there. So binomial model. So we see we go straight to an example here. So you have 2 years to go, right? So the bond, zero coupon bond, right? $100 par value, 2 years to go. Okay. So So the price right now is 80. So the par value is 100, but the current price is 80.44. So now, as you have learned in financial management, you know that if market price increases, then what will happen to the bond price?
It increases.
If market interest rate increases, then the bond price will decline, right?
Decline, yeah.
Yeah, decline. A reverse relationship, right? Inverted relationship between market interest rate and the bond price. Okay, so now we have our researchers, our analysts have made this projection. Okay, so there are two possibilities, right? Two possibilities. The interest rate could be interest rate right now is 10%. The market interest rate, right? See, the current yield or the market rate is 10% right now. It could either go up to 1382 or to 1218. Okay, so we do the situation. Yeah, right. So we will get what? 100 here. It's zero coupon bond, right? Zero coupon bond. So you get nothing in the middle, zero coupon, right? To make the analysis easier. So the two possibilities here. If the interest rate is 13 somethings, and second possibility is 12 something, right? Where is it to be precise? 13.82% and 12.18%. So if it's 13.82, then what would be the price? So first possibility, if this is at 13.82, then the price at year one would be, right? We find the present value. To the power of 1, right? Why 1? Because it's one move, look, right? From year 2 to year 1. One move only, so power 1. And then we get something. What is it? 87, 86. So this would be the value of the bond if the interest rate increases from 10% to 1382. Now, according to our analysts, there's a second possibility, which is the increasing interest rate to 1218. So what will happen here, right? 100 that we will receive in the second period, it's discounted back, right? We find the present value. So 100 is discounted back for 1 year. So one period move, right? 1218 to the power of 1, right? One move only, right? And then we will get 8914. Now there are two possibilities, right? The price will be 8786 or 8914. Okay, so okay, what would be the possibility of happening? So this example shows us that the possibility of happening is 50-50, right? Right, 50-50, right? 50%. So the chance of this one is 50%, and the chance of this one is 50%. Okay, so if we find the weighted average, right? So the 1382 is the first possibility. The chance of happening is 50%, right? Plus 1218, the second possibility here, and the chance of happening is 50%. If we find the weighted average, we will get 13. So this is the weighted average, okay? Weighted by the possibilities, right? The possibilities. So if we recalculate, so this is the scenario if we find the discounted value of 100, the present value of 100, right? 1 plus the, what's that, the weighted average, 13?
30%.
Mm-hmm. To the power of 1, right? Because it's from year 2 to year 1 period only. And we'll get, let's see the value here, 8850. Okay. Right, you see, so we have three numbers here. First possibility is 8786, right? If the interest rate increases to 13. If the market interest rate increases to 12, then the bond price, the zero coupon bond, will be worth about 8914. And if we follow the weighted average, then the value will be 8850. Okay, now we continue, right? So we make, now here, right? What's the first? It's like the value of put option, okay? Remember, what is put again? Put?
Put is the right to sell.
Yeah, the right to sell. Why you are doing this? You want to sell something because what are you afraid of? Increasing price or decreasing price?
Of decreasing price.
Yeah, exactly, right? See, you have a bond. What will make you unhappy? Decreasing price or increasing price of the bond?
Decreasing price.
Decreasing price of the bond. That's why you are taking a long put, right? So you don't take long put because of your feeling, because of your analysis. No, right? No, it's because of your position. So you have this bond, you're afraid of the decreasing value of the bond. That's why you are taking the long put. Okay, long put position. Again, you are taking the long put position because you are afraid of decreasing bond price. Right. So by taking long put again, let's imagine that the 8850 is like what? 8850 is like the strike price. Okay, so the 8850, remember this is what? The weighted average, right? The weighted average, this is the weighted average one. So 8850 would be like the exercise price, right? Will be the like weighted average based on weighted average interest rate. So this function as strike price. Now we have, this is the strike price, and we have two possible S, right? Two possible scenarios. And the weighted average comes up with the exercise price, right? So tell me now, if this one, 87 is the first possibility. No, 87 and 89, right? So if the exercise price is 8850, right, and the spot price, which scenario is that? 87. Let me look back again to make sure. 87 and 89. Okay, the first scenario is 87, right? So your strike price is 8850, and first scenario, let's say first scenario prevails. The price is 87.86. Will you execute it? You have
To put or to call?
put, right? Remember why we are taking the put option because
we're afraid of the decreasing of price.
yeah, the decreasing price of the bond, right? We have a bond. You don't like you're afraid of decreasing price of the bond. That's why you take a long put. Right? So you have the right to sell at 88.50. First scenario, The spot price is 87.86. Will you do it?
Yes.
Yeah. And how much is your profit
The
this month?
the 0.64.
Yeah, 64 cents, right? We call it 64 cents. Right? Or nothing, right? So it's between. So between this one or you don't do it, right? So if 87.8, if the spot price is 87.86, then you get this, right? What about this one? The second scenario, the strike price is 88.50, but now the spot price is 89.14. Will you do it?
No, no.
Why you will not do it? You have the right to sell at
88, but
88.50.
yeah,
But the current price is 89. Will you
the
do it?
yeah, no, because the prices increases, so selling it
Right.
would not be wise
That's
when you
right.
get it.
So the fundamental value is zero, right? It's zero in this example. Okay. So now let's calculate. We have we have figured out that in the first scenario, maybe we'll continue here, right? So in the first scenario, with exercise price of 88.50 and the spot price of 87, you will do it, right? Because you have the right to sell at the higher price. The value will be 64 cents. What about the second one? You have the right to sell at 88.50, but the price right now is 89.14. You will not do it, right? You will not do it. Okay, so then we put into the weighted average again. The value of the first one is 64 cents, and the possibility of happening, according to our analyst, right, in the story is 50%. Plus 0 times 50%. So how much is it?
0.32.
Yeah, 32 cents, right? 32 cents. So now imagine, right? So the value of the option, this is not the value of the bond, right? But the value of the option is either 64 cents or 0, right? And the possibility of happening is 50% and 50%. If we find the weighted average, this will be 32 cents, right? This is the value of the option at year one. That's why we call it binomial option, right? Binomial value. However, if you ask what is the value of the option right now, so you still have to discount it back, right? Because this is the value of the option at year one, right? So what is the value of the option right now? So of course 32 cents divided by 1 plus, what is the current interest rate? 10, right? In the story, see, 10%, and then here is between 13 or 12. So it has two possibilities, right? In year one, but right now it is known that the interest rate is 10%, right? To the power of 1, because we are here from year 1 to year 0, or right now, right? And then we get 29 cents. Okay, so 29 cents according to the binomial option. This is the value of the option right now, and 32 cents would be the value of the option at year one. Two different things, right? So you see here, to make it clearer here. So this is the current value, right? So the value would be either 87, 86 if the market interest rate increases to 13, or 89 if the market interest rate increases to 12. Right? And of course, in year two, the value will be, of course, 1, right? Because on the expiration date, the par value of the bond would be 100, right? According to the story, okay? And then here, once again, right, if we summarize here, uh, if market interest rate increases to 13%, then the market value would, the market price of the bond would be 87. Right? If the market interest rate increases to 12, then the value of the bond would be 89. Okay, and then 88.50 is acquired from the remember, right, the weighted average of interest rate. Right, 1882 and 1218, and each having 50% chance. So the weighted average interest rate will be 13, and we get 88.50. So 88.50 is like the exercise price of the put. You're one more time, right? We are taking a put position, long put, because you are afraid of decreasing bond price that you are having right now. That's why you take a long put position. Right? So now the first scenario, imagine again, you have the right to sell at 88.50. The real price is 87.86. You will do it, right? And then the value would be 64 cents. Right. The second scenario, you have the right to sell at 88.50, but the current market price is 89. So you will not do it, right? You have the right to sell at 88.50, but the current market price is 89.14. So you will let it go. So zero, right? So 50% chance of happening for 64 cents, and the remaining 50% is the chance for zero. So the worth is 32 cents, the value of the option in year one. Right? But in year zero, you have to discount it back. You have to find the present value of it, right? And then we get 29. Okay, so this is called the binomial option, right? Binomial model of option value. So we have at least two approaches to estimating the fundamental value of an option. The famous Black and Scholes option pricing model and the binomial model. Okay, so for the risk management applications of options, we'll continue with the next video, or the fourth part of the derivative markets and instruments. But for the again, the discussion on option and the methods or approaches to estimating the fundamental value of an option have been discussed in this video. So we'll end the session here. I hope the session benefits you, and see you next time in the next video. Thank you.